Herzlich willkommen zu unserer heutigen Sendung aus dem Energiestudio in Berlin. Wir wollen Ihnen heute den aktuellen Gas Market Report der Internationalen Energieagentur vorstellen. Mein Name ist Charlie Grüneberg, ich leite die Kommunikation hier bei Zukunft Gas. Und den Report wird uns IEA-Experte Gergely Molnar vorstellen. Wir sind schon sehr gespannt, denn auch wenn es sich momentan für uns noch nicht so anfühlt und der Blick aus dem Fenster auch was anderes sagt, sind wir ja eigentlich bereits im Winterhalbjahr. Wir werden deswegen auch einen Blick werfen auf die kommende Heizperiode, aber natürlich auch einen Blick zurück auf die ersten 6 Monate des Jahres 2023. Die Veranstaltung wird wie gewohnt aufgezeichnet und im Nachgang auf unserem YouTube-Kanal veröffentlicht. Wir senden Ihnen die Präsentation, den Link zur Aufzeichnung und auch den Report später zu. Und wenn Sie im Verlauf der Veranstaltung Fragen haben oder sich beteiligen möchten, dann nutzen Sie dafür gerne die Handhebelfunktion oder die Chatfunktion. And now I will switch to English, and I'm very happy to have you, Gergely, here with us. It is always very interesting to hear from you what has happened in the last weeks in the gas market. There's sure again a lot of interesting topics, and for example, in the current edition of the report, the IEA speaks of a new gas market and above all, a new role for Europe in this market. So, Gergely Molnar, the floor is yours.
Charlie, thank you for your kind words of introduction, and many thanks for Zukunft Gas for having us today. It is always a great pleasure to be back in the virtual energy room of Zukunft Gas. Today we are going to discuss the latest findings of our global gas security review. This is a report we launched back in 2016, and now it is part of our quarterly gas market update series. Today's presentation will closely follow the structure of the report. So first, we will have a look back on what happened in the recent weeks, recent months on the European and global gas market landscape, and also provide a short-term outlook ahead of the winter season and ahead of the next year. In the second part of the presentation, we will provide a thorough analysis of LNG investment, contracting and flexibility trends. And then we will have a special spotlight on natural gas storage, which has been really at the forefront of policy making and security supply policies through the last year. And then last but not least, as part of our low emission gases work program, we also would like to provide some analysis around the evolving storage situation on low emission hydrogen. As noted, the Global Gas Security Review have been just published a week ago, and it is available free of charge on our website, iea.org. Now, this slide just gives us a look back to the gas supply shock of 2022, and we are more than familiar with this story. Just to remind ourselves that Russia cut its piped gas deliveries to the European market by over 80 BCM in 2022. And this roughly equates to 15% of the global LNG market. So has been a major supply shock, both for the European market and indirectly to the global LNG market. And of course, it had a number of consequences, such as the reconfiguration of global LNG flows, spike in natural gas prices, as well as a readjustment in natural gas demand. And this slide just really shows us the depths and the growing flexibility of the global LNG market, which has been really moving in response to Russia's behavior. And this has been really the result of the growing liquidity and flexibility of the global LNG market. Very shortly, the European market has increased its LNG imports by 60%, an increase in absolute terms of 65 BCM. This has been more than double of the incremental LNG supply, and as such, it necessitated also a redirection of LNG flows from other markets, including from the Asia Pacific, which has been, of course, sort of the engine of growth for LNG demand. But last year, we have seen a drop of 7% compared to 2021. And this has been very much largely enabled by China, where we saw an unprecedented drop of 20% in LNG import requirements. And this kind of flexibility has been instrumental for the European market to avoid physical supply shortages, although at a very high import bill. We also would like to note here that more price-sensitive markets in South Asia, including Pakistan and Bangladesh, have been facing electricity supply shortages due to the inadequacy of gas supply. And this is something which is very important to remind ourselves also in the European context, that we should not re-export in a way our energy supply insecurities to other parts of the world. Now, this chart is just giving us an overview of the price roller coaster we have been witnessing through the last 1.5 years, with prices spiking last year, August, at close to $100 per MMBTU on the European market. But as we can see in the second part of the chart, market tensions have moderated down quite significantly since their August highs, and especially in the first half of 2023. And this is really due to a combination of timely policy action, effectively working market forces, as well as favorable weather conditions. As we speak now, Asian and European spot prices are approximately 80% below their August 2022 highs. And in Europe, we have seen gas prices trading well within the gas to coal switching range, meaning that gas-fired power plants, the most efficient ones, are now more competitive than coal-based generation. And also would like to note here that today's spot energy prices in Asia are below the estimated average price of oil-indexed long-term LNG contracts. So we are seeing that the market is moving towards a gradual rebalancing, and this is happening despite tighter gas supply conditions. So on this chart, we put together the key channels of global LNG trade, which is, of course, a simplified view of the complexity of global energy trade, but it sort of includes the main routes. And here we included Russian pipe gas deliveries to the European market, Russian pipe gas deliveries to China, and then other pipe imports into Europe and Central Asian imports into China, as well as the evolution of global energy supply. I think that really the key point here is that in the first half of 2023, Russian pipe gas deliveries dropped by close to 40 BCM into the European market. Meanwhile, global energy supply increased by just a mere 3% or 9 BCM in absolute terms. And as such, it was quite insufficient to offset the decline in the reduction we have seen from Russia. So this means that, that from a supply perspective, the market has been tightening. And because of that, it has been really key that the demand side is taking action. The demand and it has been really the demand side which have been driving the softening of market fundamentals. Partly in Europe, where we have seen natural gas consumption declining by over 10% or over 30 BCM in absolute terms. And this has been really driven by all the sectors. In the residential and commercial sectors, we have seen a drop of over 10%. And here I would like to note that the bulk of it has been driven by non-weather related factors. In our analysis, weather related factors explain just about 20 to 30% of the decline in residential and commercial sectors. The rest has been really a combination of other things, including fuel switching, efficiency gains, behavior changes, but also, unfortunately, rising affordability issues across European households. When we are looking at the power sector, we have seen a very steep decline in gas to power demand. And this has been partly due to the lower electricity consumption in Europe, partly due to improving hydro and to a lesser extent, more favorable nuclear availability. But altogether, gas to power demand dropped by over 15% year on year. And it has been a major contributor to the easing market fundamentals in the European context. Last but not least, in industry, we see a continued decline in natural gas consumption. And this is partly due to the continued production curtailments, the rigidity of some of the fuel switching, which happened in 2022, and on the margin, some efficiency gains. For the full year of 2023, we expect that European gas demand will decline by over 7% year on year. Now, besides the European market, it is very important to look carefully what is going on in the Asian markets. And here we see that in the first half of the year, natural gas demand has remained broadly flat at the same level as it has been in the first half of 2022. But we see quite different dynamics occurring across the region. And when we are looking at China, it has clearly returned to a growth pattern. Our latest estimate indicates that in the first half of the year, China's gas consumption increased by 6% year on year. And when we are looking at the most recent data for June, we actually see a return to double-digit growth rates, which is quite impressive. And this is due to a combination of factors, improving economic activity compared to last year when the country has been under strict lockdown measures due to the COVID pandemic, but also the underperformance of hydropower generation, which have declined by about 23% in the first 5 months. And this, of course, supported higher gas burn in the power sector, which increased by over 10% in the first 5 months. So China is sort of back on a growth trajectory, but most of this incremental demand coming from China has been offset by the demand reductions we see in the more mature markets of the Asia-Pacific region, including in Japan and Korea. In Japan, gas demand declined by over 10% in the first 5 months of the year. And again, this has been very much driven by the power sector, where we see lower electricity consumption and also improving nuclear availability. I think one of the key numbers is that Japan's nuclear power output increased by almost 50% year on year in the first half of this year. And this has been instrumental for driving down Japan's LNG import requirements. And we see a similar picture when we are looking at Korea, where we have seen a decline in natural gas demand of 6%. And this has been partly due to the milder weather conditions in Q1, but also the improving nuclear availability. Altogether, we foresee for the Asia-Pacific region about 3% growth this year, and this is primarily concentrated in China and in some of the emerging markets in the region. Now, this slide just gives us an overview, a snapshot of where are China's LNG imports at the moment. They have clearly returned to a very robust growth pattern. They increased by about 10% compared to last year in the first half of 2023. And we can see that in June, they jumped by a quite astonishing 40% compared to 2022. Now, this being said, China's LNG imports remain below the record volumes we have seen in 2021. And for the full year, we do forecast China's LNG imports increasing by 15%, but they are not expected to reach the same level of imports as we have seen in 2021. We expect that they will recover slightly above the 2021 levels in 2024. Now, coming back to Europe, this slide gives us a bit of overview where we stand in terms of storage field levels. As we speak, European storage sites are over 80% full. And if storage injections continue at the rate we have been observing since mid-April, EU storage sites could be 90% full by early August, and they could reach 100% of their working capacity by mid-September. So unless there are no major technical or geopolitical surprises, we are quite confident that the EU will be able to overpass actually its 90% field target. We expect that EU storage sites could be actually filled to over 95% of their working storage capacity. But it is quite important to note that full storage sites are no guarantee against winter volatility and the risk of renewed market tensions. Because there is a number of exogenous risks we need to consider. This includes a stronger LNG import demand from China in the case of, for instance, colder than average winter conditions or lower availability of Central Asian pipeline supplies. We all know that Uzbekistan and Kazakhstan are facing quite worrisome upstream developments. Maybe just one number, Uzbekistan's gas production dropped by 10% in the first half of the year, and the country is facing gas supply shortages. So this might have implications also on its ability to supply gas to China. Then we have, of course, the question mark around Russia. There could be a risk that Russian pipe gas deliveries into the European market will decline further. And of course, when we are looking at the global LNG supply, our base case is that based on the project's ramp up and announced startup, global energy supply could increase by about 15 BCM year on year through the 23-24 heating season. But again, we cannot exclude some unforeseen outages and black swan events. And of course, last but not least, weather will be a key component. Temperatures will be a key component determining the demand trajectory on the European market. Our analysis shows that a cold winter could increase gas demand in the residential and commercial sectors by about 30 BCM compared to the 2022-23 heating season. So all these risks are weighing on the European market, and they can have also an implication on where we see EU storage levels standing at the end of the 23-24 heating season. Our simulations shows that in the case of a cold winter and the unavailability of Russian pipe gas and the inability to attract additional volumes of LNG compared to the already very high imports of the 22-23 heating season, the European storage sites would drop below their 30% fill levels. And if there is a strong competition coming from the Asian market, then we could see also a risk that the European energy imports will drop by around 10% year on year. And in that case, we could see EU storage sites drop below 20% of fill levels. And as we all know, once storage sites are full less than 30%, their reactivity is declining, and in a cold spell occurring at the very end of the heating season, combined with low wind power output, this indeed could renew market tensions and eventually could lead to some tensions between meeting supply and demand. Now, this chart just gives us an overview of where we see global gas demand evolving in the next 1.5 years. For 2023, we consider that demand is going to remain broadly flat. We see some demand returning to growth in the Asian markets, but this is largely offset by the demand reductions occurring in the European markets, as well as in the more mature Asian markets of Japan and Korea, as well as lower natural gas demand in Central and South America due to healthy hydro availability. When we are looking at 2024, we see that global gas demand growth is expected to return with a growth rate of approximately 2%. And again, here we expect that this will be very much driven by the Asia-Pacific region, primarily China, India, and some of the emerging markets there. But we also see some potential for recovery in the European market, primarily due to higher demand in the residential and commercial sectors, because we expect, we assume that weather conditions will be close to average, and this would mean some recovery in heating demand. Altogether, in the 23-24 period, growth, the net growth will be very much concentrated in the Asia-Pacific region, alone accounting for 80% of incremental demand over these 2 years compared to the 2022 base year. So this brings us to one additional slide around the expectations on global LNG supply. In 2023 and 24, we expect global energy supply to increase at a rate of 4%. This compares to a growth rate of 8% experienced between 2017 and 2021. So, this shows that the LNG market growth at the moment is a bit slowing down because simply there is not many new LNG liquefaction capacity additions coming online. Altogether, we expect about 40 to 45 BCM of additional LNG supply in these 2 years, and the United States alone will account for almost 40% of incremental LNG supply. We also see some additional volumes coming from Africa and the Asia Pacific region, which is partly supported by the ramp up of new projects, partly due to the improving availability of feed gas supply. And then we also expect some additional volumes of LNG coming from Russia's Arctic to Train 1, which is expected to start up and ramp up in Q1 2024, but there are some uncertainties related to the schedule of the startup, as well as to the initial utilization rates of that facility. Now, this brings us to the next section of the presentation, which is about the LNG contracting and availability, flexibility update. Here, this is something we have been doing since the first Global Gas Security Review since 2016, closely tracking the investments, contracting, and flexibility of the evolving global LNG market. This slide just gives us an overview of the LNG FID activity. I'm not going to give an overview of the history, but just maybe to mention that back in 2019, we have a record year in terms of LNG FIDs, when almost 100 BCM of capacity has been sanctioned. Then, of course, there had been a drawback in 2020 when the COVID global pandemic created unprecedented level of uncertainty and has been, of course, weighing on project development and FID activity. In 2021, we have seen a return to FID activity, mainly supported by 2 projects: Qatar's North Field South expansion, which has been the largest FID in the history of LNG, as well as Australia's Pluto Train 2. Since Russia's invasion of Ukraine, we have seen about 90 BCM of LNG capacity sanctioned, and 95% of that has occurred in the United States, including Plaquemines phase 1 and 2, Port Arthur phase 1, Corpus Christi expansion, and most recently Rio Grande LNG phase 1. So we clearly see that the United States is driving that, but there have been also some smaller LNG FIDs occurring in Africa and in the Asia Pacific region. And very important to note that Qatar has also awarded a feed contract for North Field East expansion project, which is a product of about 22 BCM of LNG capacity. Now, altogether, these products which reached FID and which are already under construction would add about 250 BCM of LNG liquefaction capacity by 2030. And of course, in a way, this would could ease market tensions and could alleviate some of the supply security concerns in the second half of this decade. Now, this chart gives us an overview of the LNG contracting activity in 2022 and in the first half of 2023. There are two ways of reading these charts. One is looking at the firm LNG supply contracts, which are linked to projects which already reached FID. And when we are looking at this way to the contracting landscape, we see a decline actually, simply because there is not many place left for contracting in the projects which reached FID. A different way to look at the contracting activity is to consider all the legally binding contracts which have been signed, both with projects which already reached FID and projects which are still at a pre-FID stage. And when we are looking at this way, we see that contracting activity has rebounded. It increased by about 20% in 2022, and it increased by 10% in the first half of 2023. And not surprisingly, this has been very much driven by North America and primarily by the United States, considering the strong pipeline of projects in terms of LNG liquefaction. And when we are looking this from an importing perspective, we see that the drivers still remain the portfolio players and the Asian utilities, the Asian importers. The European buyers have increased clearly their LNG contracting activity, but their share remain still well below the share of the Asian buyers. When we are looking at sort of the flexibility of LNG contracting, we are looking primarily at three metrics. One is the length of the contract, the size of the contracts, and the flexibility in terms of destination. And what we see very clearly is that long-term contracts are becoming increasingly popular. They accounted for almost 90% of the volumes contracted in 2022, the highest share we have seen in the last 3 years. When we are looking at the size of the contracts, we have seen that the large contracts, so contracts with above 4 BCM per year, accounted for about 30% of the volumes agreed in 2022. This is the highest share we have seen since we launched our global gas security review. Now, in terms of destination flexibility, we see a mixed picture. Destination-free contracts accounted for roughly half of the volumes signed in 2022, and we see a similar share when we are looking at the first half of 2023. But there is a quite staggering difference when we are looking at sort of the geography of these contracts. Most of the contracts signed with portfolio players and the European buyers are destination free, while when we are looking at the contracts signed with Asian buyers, the bulk of them remain more rigid, and as such is categorized as destination fixed contract. Now, this chart is just giving us a view on the very robust growth in the importance of China's role in the global energy market. China alone accounted for approximately 30% of the total energy volumes contracted in the last 5 years. And this very active presence in the LNG contracting landscape results in the growing share of China in active LNG contracts, which is set to increase from just 12% in 2021 to close to 25% by 2030. And this will also enable China to play a greater role in optimizing global LNG flow patterns. But of course, this sort of balancing role we start to see played by China comes also with certain caveats, including the fact that the majority of China's LNG importing companies are state-owned, and as such, profit optimization might not be only the sole driver of decision-making. There might be also some geopolitical considerations or considerations of security of supply. Now, the European landscape is quite different in that sense. Historically, long-term contracts and domestic production accounted for approximately 80 to 90% of the European gas supply. And the rest of 10 to 20% was indeed procured on the spot market or via flexible LNG supply. This has been, of course, shifting quite drastically in 2022 due to the non-observance of Russia's long-term contracts. Our analysis shows that if the current long-term contracts with non-Russian suppliers are not renewed and no new contracts are signed, then the share of flexible LNG and spot procurements could increase to over 70% by 2030. And this is why it is important to strike a fine balance between long-term supply contracts and spot procurements from an increasingly liquid global gas market. And indeed, when we are saying that the global gas market is becoming increasingly liquid, it is important to recognize the role played by portfolio players in that space. Portfolio players are basically actors which have a diversified source of LNG supply and who are able to optimize and resell these volumes to end users through more flexible, shorter, and smaller contracts. One metric we are tracking is the net open position of portfolio players, which basically indicates difference between their purchase contracts and their sale contracts. And here what we see is that their net open position had been widening quite significantly since 2017. And when we are looking at the medium term, we expect that it will be widening further to about 50% between 2023 and 2026, based on the existing LNG contracts. Now, this net open position of the portfolio players will obviously give them a greater role to play in the short-term market and provide some additional flexibility to end buyers. So now we are moving to the third section, which is the review on natural gas storage. The global energy crisis triggered by Russia's invasion of Ukraine put gas supply security and storage regulation at the center of policy interventions in 2022. And this map just provides a high-level overview of storage policies which have been initiated over the past year, including the EU's new storage regulation, China's 14th five-year plan, which includes a very ambitious target of doubling underground storage capacity, but also Japan's strategic buffer LNG initiative, Singapore standby LNG facility, and Australia's East Coast gas system framework, which also reinforces the regulatory overseeing over storage. Now, I think we are all more than familiar with the new European storage regulation, which really sets a mandatory fill level of 90% by the 1st of November and includes also intermediary storage targets. The regulation is set to remain in place until the end of 2025. I also would like to remind ourselves that mandatory storage fill levels have been the third point of the 10-point plan on reducing the EU's reliance on Russian gas produced by the International Energy Agency just 1 week after Russia's invasion of Ukraine. But besides the European regulation, we see also renewed interest in storage regulatory frameworks in other parts of the world, including Japan, which is set to introduce the strategic buffer LNG mechanism starting from the 2023-24 heating season. And under this system, METI will designate private operators with high LNG procurement capacity as companies authorized to handle the strategic buffer LNG operations. These companies can sell the purchased gas into both overseas and domestic markets under normal conditions, while in an emergency situation, the strategic buffer LNG will have to be sold to domestic companies which are at risk of supply disruption. And of course, this will be done under the direction of the Ministry of Economy, Trade and Industry. Very importantly, the government will compensate the certified operators for any losses caused by the instructed trade. Now, this slide gives us a summary of the underground storage outlook over the medium term. We expect that underground storage capacity will expand by 9% or over 35 BCM between 2022 and 2028. And aquifers and depleted fields will account for about 75% of the incremental storage capacity additions. And the more reactive salt caverns will account for about 25% of incremental storage capacity. This will be very much led by China. Based on the projects which are currently under development, we expect that China could increase its underground storage capacity by about 20 BCM between 2022 and 28. And in addition, China has also about 7 BCM of LNG storage currently under construction. In Europe, most of the additional storage capacity will be driven by Eastern European markets, including Turkey, where we will see the Tuzgulu salt cavern storage facility to expand with 4.2 BCM by the end of this year. But we also foresee that Bulgaria will expand its Chirin storage facility by around 0.5 BCM. And of course, we see storage project developments in Poland and the return of rough storage in the United Kingdom, which will return in a number of phases, and it will increase its working capacity in phases. And we also would like to note that the number of new FSRUs in Europe is also increasing LNG storage capacity by about 1 BCM in the coming years. Now, the last part of this presentation is part of our low emission gases work program. We included into this year Global Gas Security Review a special section on this topic with a focus on the storage of low emission gases. And this scheme just gives us the value chain of natural gas as we know it today, quite vertically integrated, starting from a gas field and ending up at the burner tip of our well-heated homes. Now, the transition to a model integrating multiple gases will naturally transform the existing gas system. Gas supply chains will become more complex and increasingly decentralized. The gas quality will display a greater diversity and variability. And gas supply flexibility will be also altered by the operational characteristics of low emission gas production facilities, such as SMRs and electrolyzers. And this latter point is of particular importance also from a security of supply perspective. Now, we see that underground storage will be absolutely crucial for hydrogen to reach its full potential as an energy carrier and to respond to the evolving flexibility requirements of a more complex energy system. So storage will be key in responding to the short-term variability of both hydrogen supply and demand, driving the extrinsic value of storage. And this will require highly flexible assets with fast cycling capabilities, which is typically provided by salt and hard rock caverns. In addition, storage could meet seasonal swings in hydrogen demand and provide a security buffer against supply disruptions and sudden demand peaks. We also think that hydrogen storage could allow for a more optimal development of hydrogen networks and improve the load factor of electrolyzers. Last but not least, storage will be key to enable the short-term development of physical hydrogen trading. This slide gives us an overview of the technology readiness of the different bits and pieces of low emission hydrogen infrastructure. If we just focus on underground storage, it is very clear that salt caverns is a proven technology. It has been used in the petrochemical industry since the early 70s, both in the UK and the United States. Now, in contrast, there is quite limited experience in storing pure hydrogen in depleted fields or aquifers, apart from a few hydrogen blending projects. And in our view, there is a clear and urgent need to double down R&D and demonstration efforts on hydrogen storage in porous reservoirs. Based on public project announcements, currently there is over 4.5 terawatt hours of underground hydrogen storage capacity in different phases of development in Europe by 2030. However, none of these projects have reached yet FID, and most of them are either in conceptual phase or undergoing feasibility studies. Considering the long lead times of these projects, there is an immediate action, a need to be taken on hydrogen storage, again, which would require a concentrated effort among key stakeholders and policymakers. One very positive development we see is that there have been several open seasons launched to assess market participants' interest in underground hydrogen storage capacity, both in France and in the Netherlands. And maybe just a very good news, which have been released yesterday by High Stock. The open season which have been held actually showed a very strong interest from market participants, and actually the requested reservation far outbid the offered storage capacity by High Stock. So there are some positive developments when it comes to underground hydrogen storage, but we also see that there is a clear need to double down efforts on this front, because this is a key component for hydrogen to become a fully fledged energy carrier in the medium to long term. This slide is giving us the conclusions of today's presentation, but I'm very conscious about the time, so maybe we could leave the last 8 minutes of today's webinars for the Q&A session. So I would like to thank you for your kind attention and looking forward for your questions and comments. Thank you.
Thanks a lot, Gergely. Yes, it was again very interesting and a lot of information. And thank you also for that outlook to the hydrogen storage subject. I already received a few questions, but please feel free to post further questions. Just let me have a look on our chat. Yes. One question is regarding to the subject of contracts. What is meant by destination flexible contracts? Is this only important for gas importers operating in multiple countries?
Yes, thank you for the question. We categorize destination flexible contracts, which don't include destination clauses effectively. But also maybe best note that when you have a destination clause in some of the contracts, you would still have the opportunity to divert the cargo, but usually this would require an agreement and a profit sharing agreement between the seller and the buyer. When it comes to destination flexible contracts, the option to trigger that flexibility often lies with the seller. Sometimes it is an option with the buyer. Unfortunately, there is rarely enough visibility to assess which side really has the flexibility option. So I think that this is how we sort of distinguish between flexible and destination fixed contracts.
What is the interest on the side of the sellers to make destination clauses? Because, for example, because for the buyers, for the companies, it would be much more attractive to have the flexibility where I sell my LNG when I bought it once.
Yeah, no, I think that this goes back a bit just in the history of LNG trading, where suppliers had, at the time when the LNG trade has been still nascent, sort of to segregate their markets. But obviously, the market has been evolving quite strongly since then, both in the numbers of sellers and buyers, but also in terms of the diversity of contractual arrangements. What we see is that destination fixed contracts are still quite attractive for buyers who value, who would like to attach a premium to gas supply security, to LNG supply security. And it happens just to be the case for many Asian markets. Whereas when it comes to the portfolio players or to European importers, we see a clear preference for destination flexible contracts. And this might be also in the European context, this might be also a reflection of the uncertainties related to the long-term future of natural gas in the European context.
Mm-hmm. Another question, how do you see Russian LNG exports to Europe in the next 1 to 2 years?
Yes, so I think that there have been some calls from policymakers on reduce Europe's reliance on Russian LNG imports. I think it has been quite clear from today's presentation that we see a certain easing of the market fundamentals, and in this context, this would give also greater flexibility for the European buyers to reduce their import requirements or their imports from Russian LNG. Now, I think that that's an open question, and we see that there is a divergence also across the European markets. Some countries have been imposing restrictions on Russian LNG. Others are still procuring. That's that's very difficult to predict how this will evolve. In terms of from a purely market perspective, I think what really matters is the price differential between a European hub and Asian spot LNG prices. And here we see that this strong European premium witnessed in 2022, this will be sort of tightening. It will retain. There will be still a European premium over or at least it is expected by the forward curves, but it will be significantly tighter. And here, when you have a price differential of $0.3 per MMBTU in the favor of TTF, it is, maybe that could be a greater incentive to flow the Yamal and the future Arctic LNG 2 volumes into the Asian markets. So, we don't necessarily, simply looking at the forward curves, we don't necessarily see a strong incentive to increase the Russian LNG imports into the European market.
Okay, maybe one last question. You mentioned the risks and the uncertainties we are looking on if you are looking on the coming heating season. And you mentioned proper policies, but what could be possible measures, possible proper policies that the EU could do to give us more security on the gas market in the look of these uncertainties?
Sorry, Charlie, the connection broke up slightly.
Okay.
You mentioned policies related to demand reduction.
I mentioned you mentioned proper policies of the European Union, for example, for a higher secure for looking at the gas balance for the coming winter, and what could be concrete measures?
Yes. Yes. So I think that very importantly, this should be a demand-driven story. Demand needs to be kept in check. And, I think behavior changes were quite important. We need to maintain that for the upcoming heating season. We also need to carefully watch the dynamics in the power sector. And here, improving the nuclear availability, that's an important factor for the upcoming winter season. But also, the improving energy efficiency standards, a quicker deployment of heat pumps. All these, are ways to reduce the risk of a more rapidly increasing gas demand ahead of the 23-24 winter season. There is quite limited options when we are looking at the supply side, because what we have seen is that the non-Russian piped gas suppliers have been already running at maximum capacity over the last year. So there is limited spare capacity there. And when we are looking at the global LNG supply, it has been also quite maxed out. So, this should be really a demand side story. And the way we should reduce gas demand should be in a smart manner. So it should not be, shutting down more industry and putting people into a position that they can't heat up properly their homes, but it should be really through pushing more for energy efficiency, quicker deployment of renewables, and a quicker electrification of heat.
Okay, thank you very much. Thank you for these fruitful insights, for these interesting insights in the international gas market. It was again very interesting, and we are looking forward to the next report. So thank you for today, Gergely. Und auch vielen Dank an Sie, liebe Zuschauerinnen und Zuschauer. Vielen Dank für Ihr Interesse, Ihre Fragen. Die Präsentation und den Report sowie einen Link zur Aufzeichnung werden wir Ihnen im Nachgang zu dieser Veranstaltung zuschicken. Ich hoffe, Sie haben viel aus dieser Veranstaltung mitgenommen, und ich wünsche Ihnen einen erfolgreichen Tag und weiterhin eine erfolgreiche Woche, und bleiben Sie gesund.